Good afternoon, everybody, and thank you for joining us on today's Survey and Spatial webinar. Our presenter today is Nick Goodall, who's Head of Research at Cotality here in New Zealand. Nick is a natural storyteller, one who happens to speak fluent data. As Head of Research at Cotality New Zealand, he transforms complex numbers into clear, powerful insights that illuminate the trends shaping the property market. Since joining the business in 2011, Nick has brought a unique perspective built on earlier experience in banking and telecommunications. His varied background allows him to uncover insights that go beyond the headlines, connecting the dots to reveal where the market is heading and what that means for everyday decision-making. Nick works with a passionate team of analysts who are driven by a shared goal to help our customers make more confident property decisions. Whether presenting to the Reserve Bank or New Zealand, briefing banks or real estate leaders, or joining consumer forums, Nick's analysis is trusted, human-centred and always focused on the bigger picture. He's also the voice behind the NZ Property Market podcast and a regular media contributor helping the public and professionals alike make sense of a fast-moving market. When he's not deep in data or leading discussion, Nick is a hands-on dad of three with a love of trail running and all things sport. So I'd like to now hand you over to Nick. And as always with our webinars, if you do have any questions at all, please pop them into the Slido box and Nick will answer those as we go through the presentation. So handing over to you now, Nick.
Kia ora koutou. Yeah, well, thank you so much for having me, Jenny, and everyone on board as well. Great to come along and have a chat about the market. Certainly an interesting time to evaluate what's going on. Pretty big decision from the Reserve Bank this week on the official cash rate, so we'll definitely be talking about that one. Just very briefly, I suppose, before we get started, about Cotality, who we are. And many of you probably know us as CoreLogic, previously called CoreLogic. Literally just a name change, no other changes in the organisation, just change the name. And quite an interesting one in terms of we're a global organisation, and globally, as well as here in New Zealand, CoreLogic really closely aligned and known for the work that we do in supporting the banking industry in particular and real estate agents. But we do a lot more than that. And I think it probably suits this audience to talk about some of the other things that we do and the organizations we support. And part of the idea with changing is to go, well, people know us as CoreLogic. Should we tell everyone else what CoreLogic does, all the other stuff we do? Or do we have this new name, Cotality, and then we can take this new name to market and talk about all the other cool things we do in the industry and different clients that we serve. So the organisation globally decided to change the name and then work through that process to own a completely new name and talk about what we do. So in terms of some of those things we do, and depending on where you've come from or your actual role, you might know some of these things. But one of the core things I talk about is the fact that we actually support, it's probably our geospatial business that people don't probably know too much about. We have been formed from a couple of ex-government businesses in the past, purely privately owned now, but previously government. And what that meant was that a lot of our clients that we supported back then, we still do today, like Fire and Emergency New Zealand. So my old line is, if you're calling 111, they're using our addressing and location data to ensure that those emergency vehicles get to where they need to get to, and not just a driveway or an entry point to a property, but actually to the unit. Say if it's on a retirement home or wherever it might be, exactly where that XY coordinate is to get to the people as required. And we also support Chorus. So with the broadband rollout, they're using our data. We've got a nightly replication service with Chorus. So anytime they put new cabling in, they update that overnight, and then the next person that's in the next day knows exactly where those services have been provided to. So yeah, it's that telecommunications, utility side as well. A lot of the power companies are using our data. Fire and Emergency, as I said, a lot of the police are using our data. So there's this broad range of industries that we support that many people wouldn't know about because they would typically just see us in the paper, or they've dealt with us through banking and finance. Maybe you've got a loan from the bank. You can see that the bank might have used Cotality data to support that lending decision. Or that your real estate agent might have been using one of our products called Property Guru. So you're really broadening out that understanding of everything we do. But yeah, we're really, really sparsely spread across different industries, and having the new name gives us a chance to talk about all those cool things. So hopefully you'll see and hear more about that over the coming months, quarters, years, whatever it is. But that's the 2-minute special, I suppose. But let's get into the update. And as I've sort of stated on the headline here, we sort of termed this the market going nowhere fast. And partly, I suppose, that's because we're seeing decent activity in the market and lots of listings out there, but property values aren't going anywhere despite interest rates falling, which would typically see growth in property prices in the past. So we'll sort of talk about all the makeup of the market and why that's occurring throughout the presentation today. But as Jenny said as well, please do feel free to pop any questions as we go. I'm hoping to see them as they pop up so we can answer them live, but anything I do miss out or don't quite get to or don't see, we'll be sure to answer at the end of it as well. I'm hoping that the slides I've got today maybe take 45 minutes, and that'll give us some time at the end to cover off anything we've missed out. I'll also happily provide a version of the presentation deck today, so I'll PDF that and send that over. That can be shared with all attendees as well. So you can make notes, you can take screenshots, whatever you need to do, but certainly don't feel like you need to rush through that. We'll send out the full presentation following the session today as well. So in terms of what we're going to talk about today, I suppose the key thing for me is, we've had this massive amount of loosening monetary policy, gone from an OCR of 5.5% to 3%, but it's taking some time for that to, occur and improve our economy first and foremost, but then that generally flows through to a strengthening property market as well. So it's all about what we're watching now to see how this next phase of the market's going to pan out with all that monetary policy that has occurred. And so in terms of how we're going to work through that, really focused on the last 3 months, that sort of last 12 weeks and the big announcements and things that have changed over that time. We will talk about the lending environment and what's happening from that perspective, broad market activity. So a quick look back at transactions and value change and who's been buying. Look at this affordability position. So one of the things I've always talked about is, where we sit from an affordability perspective. Things have improved markedly now, and so we've sort of had this affordability reset that sets the market up for the future. And then one thing I've just been looking at recently, talking a lot to our colleagues over in Australia, typically New Zealand, Australia's markets are quite similar, and we've seen some quite diverged trends occur in the last wee while. So just looking as to why that might be, and if we expect to get back to a growing market, which they already have in Australia, what might it take for us to follow suit? And so we'll just look at some of those things that might influence that as well. So that's the agenda for today. I was going to say very quickly, but we will step through each of these things in terms of the key developments that have occurred in the last 3 months. And as I've sort of said right up top there, right, our economy, labour market are not doing too well, really underwhelming. And that struggling economy is really flowing through to that cautiousness across the property market. If your business isn't doing so well, or you're unsure about your job, then typically we don't see, people being willing or able to act with any great urgency in the property market. And that's certainly been happening more recently, despite the fact that we've seen more transactions, just not really at higher prices. So some of those key things, though, of course, we did see the OCR cut to 3% 6 weeks ago, and of course the strong signal for 2 more cuts. Now that was from Reserve Bank 6 weeks ago. Since then, we've had more data releases, particularly GDP data, which has led to other economists saying, might not be 2 more cuts, we might even see 3 or a couple of supersized ones. So that's still up in the air. That's flowed through to lower mortgage interest rates, of course. 1 and 2 year fixed specials now sitting around that 4.5% to 4.75% mark. So, that's sort of come down pretty decent levels from, I think it was only about April or May, 6 months ago, probably. We were saying if you could sort of get anything under 5%, you'd be pretty happy with that interest rate, but things have advanced further from there. So that's setting the market up as well. In the last 3 months, we have heard and had final confirmation of the relaxation of the foreign buyer ban. Now, it has been set above that level of $5 million for property in New Zealand, whether it's building or buying an existing property. But that only accounts for around about 7,000 properties across the country, the majority of which are in Auckland, but still a relatively low percentage in Auckland, a larger percentage, but still very few properties in Queenstown. I think it's 1,000 properties in Queenstown. So in some of those areas, you might see that increased demand above $5 million flow through to the broader market. But really, we're talking about Queenstown only. Even Auckland, I think, it's 1 to 2% of properties worth more than 5 mil. So it's unlikely to have too much impact across the board. In terms of where values have come from, they did rise in September. That was the first in 6 months that we saw an increase in property values, and it was a very small increase of 0.1%. So, nothing to really write home about, and could be a blip as well. It could be readjusted as we get more data coming in, but certainly interesting for the fact that it did stop that 5-month fall in values. And overall, values are still down 1.5% since March. So, over that longer period, we have still seen the market in decline. Activity, as I mentioned earlier, has risen. So we're up 8% year on year, more transactions occurring in the market. And listing stock has also reduced by 12%. But I think the one thing with listings, which we'll show the chart later on, is it's still relatively high in a longer term context. So there's still plenty of choice out there for people, more transactions occurring, but that desperation is not there because the buyer's still got that power. So they're sort of being able to hold on for the price they want rather than the price the vendor wants. And we have seen from a lending perspective that there has been record levels of bank switching. So, mortgage holders can run down all their fixed periods. The banks are fighting pretty hard. And so you can get pretty competitive interest rates if you switch banks. And people are certainly taking advantage of that. Probably helped out as well by the amount of mortgage lending that originates through mortgage advisors now as well, which means it feels a bit easier to jump across ship. So that's been an interesting development that's certainly hit record levels. Not last month, but the previous 2 months were a record. From an investment perspective, and rents have remained relatively subdued. In fact, in Auckland and Wellington and even some of the other main centres now, we are seeing rental prices decline year on year, which is relatively unusual. But again, just shows where that power is. There's quite a lot of rental supply out there. Demand has reduced with our, lots of people moving overseas. And so we're seeing that flow through to rents not growing. But the key ones these last couple really for the Reserve Bank on Wednesday, labour market is struggling. Unemployment has risen to 5.2%, slightly below where they expected, but overall there's sort of this underlying weakness of the labour market where unemployment hasn't risen by as much as they expect, but underutilisation is still really high. So people want to either get a job or they want more work, and they're not being able to get it right now because our economy is just lagging. And then from the Reserve Bank's perspective, of course, their one and only target is actually CPI inflation, mindful, of course, of having financial stability, and that's why they're interested in the economy and labour market as well. But their one target is CPI inflation. It has to be between 1% and 3%, hopefully closer to 2% from their perspective. And we did see it get to 2.7%. Likely we'll see a little bit further increase this quarter, or last quarter actually, Q3, once we get that data. Might get to 3%, so really pushing the top end of that band. But the Reserve Bank's been very clear at saying they know there's some short-term inflation coming, whether it's the global impacts, it's tariffs, it's weaker economy, all these things are going to have higher inflation or lead to higher inflation, but it's not going to go too crazy like we've seen in the past. And so they feel comfortable at continuing to drop interest rates, even though that could have some upwards pressure on inflation. So these are the things they'll be balancing at their conversation on Wednesday afternoon anyway. So in terms of the Reserve Bank, yeah, look, it does feel like they've lost patience with the economy. They've been waiting for all this loosening of monetary policy and dropping the official cash rate to see that flow through to a growing economy. As interest rates fall, we're essentially encouraged to borrow more and spend that money in the economy. Hasn't really been happening. And this the big lag in New Zealand in particular is influenced by the fact that we fix our interest rates at mortgage interest rates. And so it takes some time for us to actually get those lower interest rates if we're fixed for 1, 2, 3, or, maybe even 5 years, 5 years ago. So it does take some time for monetary policy to flow through to the economy. And I think they've sort of shown in their latest statement that they have lost patience a little bit. They've continued to drop interest rates. They've forecast those extra 2, which could well be a total of 75 basis points before the year's out, really to try and kickstart this economy. Because while their main focus is, of course, inflation on the right-hand side, and there is some short-term volatility for that, it's important that we have a strong economy for our financial stability. And so that's why the Reserve Bank's obviously mindful of what's going on in that space. I think that one of the things that, is sort of becoming more of a conversation now is that, I think we've heard in the last 5 years, especially through COVID, post-COVID as well, that we need to see monetary policy from the Reserve Bank be assisted by fiscal policy from the government. And same thing on the flip side, right? When the government provided all that support in COVID times, they talked about, fiscal policy need to be supported by monetary policy. So I think we need to see these two things working together. Whereas right now, the Reserve Bank has certainly been trying to boost the economy with lower interest rates, and maybe with the fiscal tightness of the current government, they haven't really had that support from the fiscal perspective. But one thing that the government will be mindful of is that going into an election year next year, if we're still in a recession or the economy is not doing so well, typically the standing government doesn't get re-voted in. So the Reserve Bank, the government, will certainly be conscious of that, and knowing they'll need to start trying to find some levers to pull to get us out of recession, to see a growing economy, businesses doing better, people feeling good in their jobs, start to see the economy grow, and that'll make them in a happier state when they come to vote next year. And from the government's perspective, re-vote this current government in, or certainly a national-led one from the Prime Minister's perspective anyway. So it's an interesting time for sure, mindful of that inflation, but definitely wanting to see that support coming through the economy and that labour market in particular, which doesn't look so great right now. In terms of what's happening from a lending perspective, we have seen that bank switching at all-time high levels. We do expect that to continue. This is the purple line on the left-hand side, people switching banks or refinancing to a different bank. That purple line did increase, as I said, for over time it's been increasing. Did dip back down in August data, but previous to that was a couple of record months. There was just less activity happening across the board, but certainly bank switching still pretty strong there and likely to continue, as I talked about. Those people are floating lots of money. They're short-term fixing for 6 months or so. Typically, we might fix our mortgage in different parts, right? Someone 1 year, someone a longer term. And so what that means is you actually become quite sticky with your bank, because at almost every point in time, you've got one of your loans or part of your loan is still fixed with your current bank, which makes it hard to leave. But as we've been on this downward trajectory of interest rates, people have been letting all of their, different parts of their mortgage expire. And so they're much more free to go, if you will. And so with that advent, plus more people through advisors, I think that's just meant that there's more people able and willing to be able to move. And then with really competitive pricing, they're certainly willing to jump ship and go and get the best rate they can, and potentially with cash back as well, of course, if you can get that from one of the banks as well. So yeah, certainly an active market from a refix perspective. Chart on the right hand side is certainly one that the Reserve Bank are very mindful of. That we have seen people rolling off those older rates that are upwards of 7% onto lower rates now, so they do get a bit of extra money back in their back pocket. And the Reserve Bank's perspective is, hopefully they go and spend that money in the real economy, go on some domestic holidays, or buy a car, or in the property market, whatever it might be. But we've still got a big chunk of those people to roll off those higher rates too. So while we haven't quite seen the reaction in terms of people getting onto those lower rates, seeing reduction in their mortgage payment size, and then go and spend that money, there's still some hope that will continue to happen. As we see on that right-hand side, there's still sort of 32% of all lending is due to expire in the next 6 months, and almost all of that will be on a lower rate than what they were previously on. And then another, 30-odd% between 6 and 12 months. So the next 12 months, we're still seeing, 60-odd% of all lending, refix on probably a lower rate. Plus you've got that 12% floating right now too, which you float on a slightly higher rate. You might likely, shift that to a fixed term as well once you feel like we got to the bottom of the cycle. So there's a lot of money that's due to be refixed soon. As I say, the key idea is that once you fix that, you go into a lower mortgage rate, your mortgage payments decrease, more money in your pocket. It's just whether you start to save that. And that's partly of what's happened more recently, is that even though people might have saved some money from their mortgage payments, they're either holding on to that, or it's going to other costs because our cost of living is still quite high, or they're holding on to it because of a job uncertainty. So they're stockpiling a bit as well. So, sort of take all of these things to change. You want the improving economy, more consistent labour market, and these interest rates to continue to fall, to really create that emphasis on people being able to be comfortable to go, yep, cool, now I'm saving money in this area. My other fixed costs are maybe reduced. Rates, yes, they've increased more recently, but can't continue increasing at the same rate they have in the past. And so they start to feel a bit more confident to go out there and go out for dinner more often, or buy those big ticket items, and that starts to see our economy grow at the same time. So yeah, there's a few things there that'll occur, and we'll certainly talk about that more shortly, particularly when we look across what's happening across the Tasman over in Australia. So in terms of activity, as I talked about earlier, sales transactions, this is sales volumes on the left-hand side, just typically, just literally the number of residential properties changing hands on the left-hand side. You can see there that we're still seeing growing activity. New Zealand sitting up around 8% year on year, more sales occurring in the last 3 months than the same 3 months the year before. Pretty much across the board for most of those main centres, though here in Wellington, things are still struggling. And, when you look at that local economy here in Wellington, job market supported by public sector, but also private sector has been impacted by the the public sector pullback. And so we haven't seen quite the same confidence or quite the same level of activity across the Wellington market, but it is still up year on year, just not to the same degree as those other larger centres or other large centres. Christchurch, Hamilton certainly sticking out there. Tauranga doing all right now as well, up around that sort of 10 to 15% mark. But of course, that's coming up against the listings situation on the right-hand side, where stock is still quite high. There's still quite a lot of choice out there. So even though we've seen more transactions, and that has led to listings falling away through those winter periods, which is all, as you can see there, pretty seasonally normal, they're still relatively high compared to the last 5 or so years. Certainly nothing like what we saw in 2021, where there are very few properties available for sale. Obviously low interest rates, so strong demand, and that's what led to increasing prices. Right now we've got increasing transactions, lower interest rates, but we've still got high stock levels. So a lot of property available for sale, staying on the market a little bit longer too. People can be picky. They can say, I'll buy the property, but you have to, fix the roof, or, any little thing that's wrong with it. You can basically say to the vendor, fix that up and then I'll buy it. Or they're not worried too much at all, because they know if they don't buy that property, they can probably get one down the road that's either on the market right now, or there'll be more coming on the market in the future. So that power is firmly in the buyer's hands. It might not be quite as strong, that buyer power, as it was last year. We can see that purple line was above where we're at right now, but it's still high in a relative sense. And now a really interesting time as we move through the better months, the spring and summer months. Typically see listings start to increase, peak around about end of November before we go to our Christmas break. It's interesting to see how that line sort of trajects over the next couple of months, and see if we do see an increasing levels of stock, or if the properties that are coming on the market get snapped up just as quickly. And we might see those levels just hold down a little bit and get a bit more closer to some of those 2023, 2022 levels, which might be more in balance, and see some price growth off the back of that one. So certainly set out for an intriguing time through the rest of this year anyway. In terms of what that's meant for property values, as I mentioned, 0.1% growth in September. That did come after 5 months of slight declines. As you can see on that left-hand chart, the purple bars there showing monthly value change over time. We've been through a pretty flat period though. When you look at this, you can look at the chart on the right-hand side, the New Zealand line's not there, but most of those lines for the main centres, aside from some, growth at the end of 2023 and start of 24, then decline in 2024, we really have seen values essentially sideways for 2.5 years. They really haven't gone anywhere for that period of time, aside from that little volatility through the centre there. So, properties really haven't seen much growth over that period of time. Has been improving affordability, which we'll look at in a second. But, you're getting some pretty stark differences across the main centres too. Once again, here in Wellington, values are still 25%. That's the yellow line on the right-hand side, below that peak of the market at the end of 2021. Yes, they're up 4.7% since pre-COVID. So, but that's 5.5 years ago now. So that's really not much growth over that longer period of time. But there are some differences there. You can see Christchurch is only 4.3% below peak, so it didn't see quite the same growth levels, and similarly didn't see the same declines. But that sort of reddish line down the bottom of that right-hand chart just shows you that Christchurch is much more, the property values are lower on average. And so that's meant that they haven't really had the same volatility that somewhere like Wellington or even Auckland, still 22.6% below peak. So we're seeing the same decline. That's the purple line at the top there. Strong growth, but an also strong decline there. And then values have essentially been sideways for that 2.5 year period as well. In terms of who's been active, this is our buyer classification series, certainly one of our most valuable data sets, where we classify every single transaction in the market to one of these groups. The main few being our first home buyers in that peachy colour that on the left-hand chart here for New Zealand, it's risen to 27.75%. So far, or through Q3, we saw 27.5% of all sales go to first home buyers nationwide. We've seen the dark purple line, which is multiple property owners, typically investors, but not always, who purchase a property and use a mortgage to secure that purchase. They've seen their activity increase more recently too, so obviously benefiting from falling interest rates, finding a bargain out there, being able to justify if they're holding long term as well. Yield has improved, but it's not great. So there's different motivators out there for investors, but we've certainly seen their activity increase more recently. They've jumped up to 24.6% after a few years of relatively low activity. They have also obviously benefited from things like interest deductibility coming back in full force as of 1st of April this year. So for this financial year, so some of the regulations have changed. Brightline test is shortened back to 2 years as well. So some of those regulations that have sort of kept investors out of the market previous to the last couple of years, once they've changed, they've sort of seen them move back into the market. Another big one is that mover line in black. Those are people that are just moving house, so owner-occupiers moving house. You can see that over the last few years, their activity has been below their long-term average, typically closer to that 30% mark. They've dropped to 25% in Q3, a little bit above that previously, but really there's been some reduction in people moving house, and that's really due to uncertainty. People that otherwise would move, they've had life stage changes, they growing family, or they want to move into a school zone. These people that typically would move house maybe haven't done so more recently because that's been the uncertainty in the economy, uncertainty over their job. They've held back. Now, one thing that might mean, though, is that there could be some pent-up demand to come from that mover group as the economy starts to improve. Those people that wanted to move house hadn't done so. Now could be their opportunity if the economy improves, their job becomes more certain. They start to go, yeah, we can actually do that upgrade, or we can move to that area we wanted to previously. So we might see some pent-up demand come from that group. So the market is kind of shaping up for all those three groups to continue their level of activity or grow their activity. First home buyer market, if you're ready to buy, there's no reason not to continue to buy now. If you're buying long term, there might be some short-term volatility, could be some prices decline in the short term. But if you're holding long term, we do expect that growth will come back in the market, as it often does, supported by lower interest rates in particular in the short term. So first home buyers to continue, investors will continue to find some value in the market, and movers to come back in as well. You could sort of see some strengthening of all those groups in terms of number of sales, but of course it has to add up to 100, so they're not all going to be able to grow the proportion of sales. So it'll be an interesting one to see how this pans out as well, as they sort of start to get a bit more competitive, and maybe we start to see some upward price pressure if demand continues to grow from each of these buyer groups as well. I will just briefly touch on some of the other groups, just because many of you may not have seen this series. The pink line going through the middle there that finishes at 10.9%. Those are multiple property owners who have bought a property, but maybe they haven't used a mortgage for that purchase. That doesn't necessarily mean they're a fully cashed up buyer. It might be a multiple property owner who has 4 properties, and they've got mortgages on all those 4 properties, and they managed to refinance them all to essentially raise the cash. So when they buy another property now, they don't actually need to go and secure a mortgage against that property right now. So not to say that they're fully unburdened by debt, they just didn't need to use a mortgage for their most recent purchase because they've been able to draw on the equity they've got from other properties. So they're typically pretty consistent over time. They don't change too much, not as affected by interest rates because they've got the level of equity. And you can see they've sort of faded away a little bit more recently to 10.9%, but their number of transactions is pretty consistent over time. New to market is the orange line down the bottom. You'd think that's pretty similar to a first home buyer. I suppose the key thing for us when putting the series together was that our first home buyer group, we wanted to be really clear cut. It had to be everyone on the purchase of the title were new to the market, never owned residential property before in New Zealand. They've also had to have used a mortgage to secure that purchase. And it's a single title transaction. So there's no complexity with buying multiple titles or multiple properties in the same month. If they didn't adhere to any of those or all of those criteria, we put them into that new to market group. So it could just be a cashed up first home buyer. It could be someone that's buying from overseas, that has money from overseas and has come here, Australian, Singaporean typically, of course, because they haven't been affected by the foreign buyer ban, or someone like that would have purchased in that market. But it's a pretty small level, and they don't affect the market too greatly. The re-entry is someone that did own property in New Zealand in the past and has left the market for at least 6 months or more. Now, they might have sold their property, couldn't find one they liked, and so they've gone renting in the interim. There might be someone that moved overseas, sold their property, and has come back to New Zealand and re-entered the market. Could have been someone that sold a property, I don't know, couldn't afford to hold on to it, moved back with the parents or whatever, and then bought again. So there's someone that had a short period or a period of at least 6 months out of the market and has re-entered, again, relatively small. And then there's the other group down the bottom, which, we just can't classify into one of those main groups. And so we chucked them into the other basket. So, I think the typical story here is that first home buyers have continued to be strong. Investors are working their way back into the market, but it's not necessarily affecting those first home buyers. It's really those movers that haven't been as active as they have in the past more recently, as that uncertainty has hung over their head and they've just held back from making any big decisions on property. That remains true of Auckland too. And I like putting the Auckland one in there simply because that 29% of first home buyers, or of sales going to first home buyers, could seem relatively high when you look at the average property price in Auckland. I think what it shows, and one of the things we look at in the detail here, is that there's a wide range of property types available in Auckland. It's a big city. If you can, there's plenty of options from terms of houses, townhouses, units, apartments, if they want to go into that too. And so that diverse range of property types means that first home buyer activity is still strong in Auckland as well, despite the overall average price being high. You don't necessarily have to go and buy a house with the yard and all that sort of stuff. And so that means that first home buyers typically find a way in the Auckland market too, when you might expect that it could be quite difficult for first home buyers. But if they've got good jobs, double professional, no kids, there's plenty of options for them to get into the market. And we've seen their activity continue to hold pretty strong over the last couple of years. We have seen investors come back as well. Movers certainly haven't been as active. And so, I think that the Auckland one's just another good illustration of the first home buyer strength and how that can be. From an investor's perspective, as I mentioned earlier, rents have been really subdued. Chart on the left-hand side there just shows you the purple or the pink bars shows you the change in rent in the last year. I mentioned earlier that Auckland's been negative, Wellington's been negative. Actually, Tauranga has dipped into the negatives now too, Christchurch as well. slight increase in Hamilton, and the only main centre with any real growth in rental prices is Dunedin, which is of course quite unique given it being such a strong university-focused city as well. And then just the dollar value just shows you the actual median level of rent in those places too. So you can sort of compare some affordability there. Tauranga more expensive than most. Auckland just behind there as well. So, from a rental perspective, still pretty expensive, but things are sort of flat or slightly declining in the last year as well. And of course, from an investor's perspective, you want to see a growing population, you need demand for tenants. When we had this really strong migration of lots of people moving here and very few people leaving, that's a strong demand for property. Now, whether that's buying or renting, it certainly flows through the property market in one way, shape or form. And we've seen more recently with a massive slowdown in migration, more Kiwis moving to Australia and abroad, fewer people moving to New Zealand. Those migration figures have fallen away. That just means less demand, typically in that rental market too, because as I said, with the foreign buyer ban, not many people can move here and buy a property straight away. They'll go into the rental market first. Less migration means less demand. And that's just one of those other factors, as well as some of the affordability questions. That means there hasn't been any growth in rental prices, because much like buyers have the power, tenants have a bit of power in that rental market as well. With high rental supply, demand not quite as strong as it otherwise would be. And so we've seen that flow through to declining rents and a pretty weak rental market as well. Put a few other notes there as well. Tenant affordability is stretched, heaps of listings, migration's down, investors facing those high costs, right? Those high costs that are affecting homeowners are through and through. Those higher insurance rates, those higher council rates, you can't necessarily pass those on to tenants all the time. Typically, we see rents are mostly affected by tenant income and not by landlord costs. And so despite those costs going up, you can't necessarily pass those on, especially when there is reduced demand and high supply. And so that's really flowed through to that lower level of rental growth. And the last one there is, I suppose it's a bit fluffy, but it's this sort of potential or perceived political risk. And certainly when we talk to investor groups out there in the market, many of them are mindful that if we did see a change in government next year, they're worried that we could see a reintroduction of a longer bright line test. We could see more regulation from maybe they do take away the ability to write your interest costs off and your tax return at the end of the year. Now, I don't necessarily think those things will be priority for even a left-leaning government, but there's certainly a mindset out there from investors that, if we get a change in government, then they could see more regulation on the market, and that might hold them back, because what we've seen in the past, if those regulations come in, it could likely lead to less price growth in the future. So for any investor that's buying on that hope of future growth, maybe more cautious of buying into this market right now. Depending on if we get a bit more clarity about who could win the election next year, that might lead them to be more active if they are confident that a national-led government comes back in again. So there's a few things there, I think, just holding that investor demand back. As we saw from the chart earlier, investor activity has increased, but maybe not increased as much as you'd expect when interest rates fall at the rate they have. So it's sort of a little bit constrained, I guess. Even though conditions are better now than they were a couple of years ago, they're still not exactly storming away because of all those reasons we just mentioned. Talked about the affordability reset, and look, affordability has improved quite a lot more recently. The left-hand chart, the line I'd like to focus on the most is the pink line on the left-hand chart, which shows you the share of income required to service a mortgage. It's essentially, for a first-home buyer, it's assuming a number of things, such as a 20% deposit and the median price in that area with the median income, what proportion of your income is required to service that mortgage. So it does take into account where interest rates are at, whereas the orange line on the left-hand side is that simple property value to income ratio. And you can see there that as we went through COVID, of course, property prices increased, affordability worsened, property prices fell, affordability increased. But even though affordability technically improved on that measure, interest rates grew at the same time. And so that pink line, when the orange line dropped, the pink line plateaued because interest rates went up, which counted how much you might be able to get a cheaper property, but your interest rates went up, so your mortgage payments stayed the same level. So that affordability perspective in terms of mortgage serviceability, or the ability to actually get a mortgage, actually didn't improve for the last few years, even though prices were declining. Now, it's only more recently, now that property prices haven't really grown and interest rates have continued to fall, that we've actually seen a genuine improvement in mortgage serviceability. And this is one of the things I've been looking for the last couple of years, really, is that my position was always, if mortgage serviceability improves, you could see some real demand increase. And again, that's when you start to see upwards price pressure because more people can afford to borrow the money required to buy a property. And so more recently, we've seen that drop back down 42, 43%, median income required to service a mortgage, still slightly above that long-term average, that horizontal pink line there, just showing the long-term average. So it's got close to the long-term average, but still not quite as affordable as, say, it was through the 2010s when prices were still, relatively low, hadn't gone through the significant growth phase, and interest rates were relatively manageable through that period of time as well. So it's better than it was the last couple of years, but it's still not like we're, way more affordable than we have been in the last couple of decades. Briefly on the right-hand side, look, that purple line on the right-hand side, that's the years to save a deposit. You'll see the trend's exactly the same as the price to income ratio. That's simply because basically what we do is say if you've got to save 20% of the median property price, how long would it take to save that given your income? And you can see there that the trend's exactly the same because those values or the key stats behind that measure are very similar to the value to income ratio. So it has got easier to save for a deposit, but again, as long as you've got that job. But the other line there, that peach line on the right-hand side, shows you the proportion of income required to service your rent. And that's the one thing that hasn't really improved recently. Rents have continued to grow prior to this year. And so that's really just meant that that high proportion of income required to service your rent has not really improved that much. But what that does also say is that if you're paying lots in rent and it's pretty unaffordable to be a renter, then that motivator, I suppose, to become a first home buyer is relatively strong. You're exiting an expensive rental market. You're buying your own home. You can probably service that mortgage on similar to what you're paying for rent. Yes, you've got extra costs, so you've got to be mindful of that. But if you're buying that long-term asset as well, that motivator is really strong for first home buyers. And I think that's a really strong contributor to why we've seen that first home buyer activity continue to grow over the last couple of years. Even though things have been pretty tough for many people out there, first home buyers have managed to find a way using that KiwiSaver, exiting the rental market, buying long-term. All those factors have remained true, and that's certainly been the case more recently. Just looking at that for the main centres, and I think one thing that's really interesting is that, with that value growth not occurring and declining in Wellington now sits out as the most affordable main centre of the 6 main centres that we typically track. That yellow line now dipping below everywhere else. So I think that's one of the things, could stand Wellington in relatively good stead for future high relative incomes here in Wellington. Prices have now come back and held back down lower than otherwise, so it's actually getting relatively affordable once again. But I don't think you'll see any growth occur there until we see the local economy start to improve. And again, going back to that fiscal support, it could be, once the government starts spending, starts to really reinvest in the ministries once again, those public servants feel more confident and we start to see those first home buyers and other buyers start to act across Wellington if more people are moving here. I think, between censuses, Wellington was one of the few places that saw population growth decline. So it has sort of been a city doing it pretty tough recently. But, now being more affordable at some stage, we might see that start to turn once again if people are evaluating where to move to, whether it's, one of the main centres, Auckland, Wellington, Christchurch, or wherever they can find a job. That Wellington picture starts to look a little bit better now. Now, I wouldn't, take too many comparisons here. Like, it's obviously good to look across the different main centres and see what's, at the high level more affordable than others. But there's also going to be a quality thing here, right? So Wellington, might be, more affordable in terms of your proportion of income required to service a mortgage in Wellington is cheaper than it is in Christchurch. But, if you buy a property in Christchurch, I can say you're probably going to buy a newer property, which might cost you less in the long run if it's already well insulated and it's newer stock than if you buy in Wellington, which is still relatively dated stock and hasn't seen the same regeneration that Christchurch did, obviously following the earthquakes and essentially building a whole new city down there. So, it's not just it's not as easy just to go, it's more affordable, so you're going to see growth in that city and not the other one. That quality of stock has to also be accounted for. So, they're all pretty well placed or pretty similarly placed from either of these measures. But there are lots of other things to take into account, not least the job market, as I mentioned, but also that quality of stock as well. So, another one to see. Interesting how that one pans out, but starting to shape up quite differently now for where it's been the last couple of years. In terms of expectations on the future, this chart on the left-hand side shows you the number of transactions. We've got a sales volume forecast. So it typically looks and says if interest rates continue to go on the forecast, the Reserve Bank says, if we do see some GDP growth come back, if we do see some migration increase, what are the other factors? There's a couple of others in there anyway, but if we put those forecasts into our model and then it predicts how many residential transactions are likely to occur. You can see that for this year, we still expect to get close to that long-term average of about 95,000 transactions that occur every year in New Zealand, coming off a very low base. I think we've got as low as 65,000 transactions in 2022, slowly increased last couple of years. Expect that to finish up close to 100,000 this year, and then getting back to some sort of level of normality next year if this market shapes up the way we expect. GDP growing, interest rates continue to hold relatively low, migration starting to come back. All these factors should see transactions continue to occur. And typically when there's more transactions, we would see that flow through to increased property prices too, as that generally eats into the stock. So demand holds up, supply reduces. You see that flow through to upwards pressure on prices. In terms of, I suppose it's still worth acknowledging again that the buyers still do hold that power. Vendors aren't desperate to sell, and that's where there comes this bit of a standoff where the vendors aren't discounting massively because they don't have to sell necessarily unless they lose their job or some other life thing hits them. But we haven't seen too much of that, even though I know that there's been an increase in unemployment. So there's sort of this standoff at the moment. Buyers know they've got the power because there's heaps of stock out there, heaps of choice, but the vendors aren't just willing to take any price. They're still willing to hold on to that property if they can do and hope for a better price in the future. And that's why we see that lengthening of the days to sell as well. What this could mean for property prices, look, this chart on the right-hand side is taken from the monetary policy statement from the Reserve Bank in August. I like to put the previous monetary policy statement forecast as well, so you can sort of see how things change in the 3 months between those decisions. The decision this week from the Reserve Bank is a monetary policy review, not a full statement. So they don't publish all their forecasts. They simply make a decision, publish a short review. They don't update these forecasts. So we won't get a picture on this until November in terms of how it's changed again. But what was really interesting, I suppose, was that previously the Reserve Bank expected about 3.5% value growth over this calendar year, over 2025. They changed that in August to essentially 0% or a minor decline across the whole year. But then getting back to some level of growth next year before sort of meeting some sort of level of normality or long-term average of around about 5% growth for next year and into the next year after that as well. So, it's not our forecast, but we probably subscribe to this in a rough sense. Personally, I probably sit that, we might see a bit less growth than that, maybe 3 or 4% growth. But it really will depend on what happens with the economy and our job market as well as to whether we do see that growth come back to that level. We do think longer term, we're unlikely to see quite the same swings in value now than we have in the past. There's a number of factors that sort of led to strong growth over multiple decades here in New Zealand, not least the doubling of household incomes, significant shift in interest rates from levels of 20% down to 5%-ish. Land changes as well. There's been a lot of changes with Auckland Unitary Plan, which allows higher intensification, but land restriction has certainly been one of the other factors that over the last sort of 4 decades has led to strongly growing property prices year on year or decade on decade. Those land use changes have changed for the better, I would say, and will mean that there'll be less upward price pressure in the future. So there's these fundamental factors that have changed that are likely to see the average annual growth rate of property prices be lower in the future than we've seen in the past. I think typically over the last 40 years, the average annual growth rate is about 7 to 8%. We probably think it's going to get closer to the 3 or 4% level for a long period of time, much closer in line with income growth. So if income grows to 3 or 4%, we expect that to flow through to similar levels across the country. And property prices, it's not to say there won't be some volatility, upwards and down of that 3 or 4% over time. It'll be different region to region, depending on how those economies all perform. Main centres will be different to some of those regional centres. Certainly right now, we're seeing stronger growth in the smaller regions than the main centres. So those things will still occur. There'll still be cycles to the property market, but longer term, we do expect that overall average to come down as we move through the next couple of years. And then I look across to Australia. So I think that one of the reasons I pulled this out, I sort of touched on it earlier, that it was really stark to me. It wasn't last month's data, it was the month before when we had our 5th month in a row of declining property values. In Australia, they had their 7th or 8th month in a row of increasing property prices, to the point where they even had, I think it was 0.7% value growth in August and then 0.8% now in September. So quite a different performance of those two property markets, despite so many similarities across our country. So I really want to do a bit of a stock take and go, what's different here to there? And how could we look at what's happening in Australia to then go, okay, cool. If our market or our economy, our status starts to shift towards more of theirs, that's when we might start to see the growth they're seeing in the property prices. So let me step you through that, I suppose. And Reserve Bank, in terms of where the Reserve Bank in each country is at, we tightened more, and now we've actually loosened more as well. Reserve Bank last week in Australia held their cash rate at 3.6%, and they actually said, they'll take some more time to assess the impact of all that loosening that's happened in the past. And there's not actually an expectation of any cuts to come this year. On the flip side, of course, Reserve Bank here expected to cut by at least 25 basis points on Wednesday, if not 50. And they're already cut down to 3% in August as well. So, and as I say, more cuts to come. So I think there's quite a different position there. Now, one of the key things with that is that, as I mentioned earlier, we fix our rates in New Zealand. Most of mortgages in Australia are actually on the floating or variable rate. And what that does mean is that when you tighten or loosen monetary policy, you see a much more faster reaction in the market. If you're a floating rate and the rate goes up, the OCR goes up, then you see that almost immediately in your mortgage payments. And that happens in Australia. So what that means is that when they do tighten monetary policy, they see a much quicker decline in people's spending because they're having to pay more on their mortgages. Same thing on the way down, loosen monetary policy, people save money in their mortgage payments, they go and spend that in their economy. So very different markets from that perspective. And that leads to a more reactive and more effective monetary policy process as they go through that change. So that's something we can't really, you can compare it for sure, but certainly not something unless we change the way that we fix our mortgages and the pricing that occurs on those mortgages. It's something that's going to always be there, or certainly for the foreseeable future anyway. The labour market is certainly a big part of the difference here. Their unemployment is only 4.2%. Ours is 5.2%, a much more broad-based economy, a higher wage economy. Heard about all the Kiwis going to Australia. If you're a New Zealander in a job that's transferable, whether you're a police person, a nurse, a school teacher, a builder, typically those jobs that are the same across both countries, if you can do it over there, you're likely going to earn more money. Now, you might have more costs as well, so you've got to be conscious that that's always going to pay off. But with a higher wage environment, that attraction is there to move to Australia, and they've seen their labour market continue to be relatively solid. And here we obviously haven't. We've seen a pretty significant increase in unemployment level, and more people looking for more money as well as they're trying to keep up with costs and hold on to their job as well. Any details there? Underemployment decreased over there. Underutilization here has continued to increase to 12.8%. So that's essentially people that are not working as much as they'd want to, whereas over there unemployment's low, and also underemployment has also decreased. So there's fewer people out there that go, I want actually a bit more hours, a few more hours. On almost all measures, that labour market is so much stronger over there. And that doesn't just attract New Zealanders, that attracts anyone else that's looking to move abroad. So someone that might be in America or in the UK or in somewhere across Asia, and they're looking to migrate to, a different country. If they're going to look at Canada, Australia, New Zealand, wherever, if you're looking at Australia or New Zealand right now as a comparison as a foreign migrant, the attraction of Australia is so much stronger. So it's not just the drag of New Zealanders across the Tasman, it's also people choosing to go to Australia rather than New Zealand as well. So that's just, and we talked about the migration figures earlier, we haven't seen as much migration, and that job market is certainly a strong part to that. The listing situation is really different across the two countries. Yes, our listings are below last year, but as I mentioned earlier, they are higher than they have been in the last 5 years, whereas their listed level supply, advertised supply, is below their 5-year average across all of their capital cities. So they are seeing actually relatively low choice. That means that when the demand is high and increasing because of lower interest rates, then they're actually seeing that upwards price pressure because that choice isn't there. And that buyer power isn't there so much because there's so few properties available for sale for them. So another big picture difference there. Touched on the value change before, 0.8% growth in September. That's the 8th monthly increase in a row. Forecasts suggesting they'll finish, the year at 6% in total upwards. Whereas what did I say for New Zealand? It's, essentially going to be flat over the year. So a pretty significant difference there. We've been flat since February 2023, and we're seeing the regions actually outpace the main centres. So we're seeing this sort of two-speed property market, much like we've got a two-speed economy right now where the regions are doing better, supported by agriculture, which is still doing quite well, but it's one of the few industries that are actually growing our economy or trying to grow our economy compared to those other ones in different services, certainly government as well, that haven't been going so well, hospitality, all those areas that haven't seen any growth in that. There are some differences from a regulatory perspective as well. Here in New Zealand, we are managed solely by the Reserve Bank. In Australia, APRA actually do their regulation of lending practices, not the Reserve Bank of Australia, and they manage a serviceability buffer. So essentially, if you get a mortgage in Australia, your income has to justify that you could pay that mortgage back at 3 percentage points higher. So if you're going to get a mortgage at 4.5%, you still have to be able to justify paying that mortgage at 7.5%. That's the key regulatory difference over there. But the APRA have talked about the fact that they're looking at debt to income restrictions, much like we've now got here in New Zealand. And they also do split lending caps and interest rates depending on the reason for that lending. So owner occupiers pay a different interest rate to investors, and they can actually put an investor lending cap on their lending as well. More recently, I suppose it is regulatory because the government's now announced more first home buyer support, and that's typically going to see more demand lift, which will see higher price growth as well. So really interesting when you've got these demand side policy changes. All it really does is, if you get a $10,000 grant from the government to get your first home, all that's really going to lead to is property prices to be $10,000 higher than they otherwise would have been, as opposed to it having any real improvement in affordability. It just means more people can buy that property, and so we see prices increase off the back of it. So it'll be interesting to see how that plays out across the Tasman. Certainly, most of the commentary I've seen is that it's a government play more than anything else, because if you can keep first home buyers happy, once again you can sort of gain more votes from that perspective as well. Here, of course, DTI limits now in place as well. So I didn't talk about that earlier, but one of those things that will be holding that investor lending back to some degree, or investor activity to some degree. Yes, we've seen improved regulation from the loosening of the bright line test, from the reintroduction of interest cost deductibility. I was going to say there's something else as well, but there's a few other changes, of course, that are leading to improved regulation from an investor's perspective, but the DTIs go the other way. LVRs, of course, loosened to a 30% equity requirement rather than 40% where it's been in the past. So, give with one hand, take with the other. DTIs aren't having a strict influence on the market just yet, but certainly starting to become part of the conversation. When interest rates fall, you can technically borrow more money compared to your income. Debt to income limits, where as a first home buyer, you can't borrow more than 6 times your income, investors more than 7 times. As you can borrow more because interest rates fall, these DTIs are going to start to actually bite a little bit, and that will hold back what that demand looks like long term. And when you go back to my thoughts around what that long term growth rate could look like, if the DTIs remain in place and at a similar level, that would just be one thing that will limit what that demand growth could look like, which will also limit what that value growth looks like over time. And then touched on the affordability perspective before as well. Affordability on those measures, particularly that serviceability one, best since 2019, servicing about 44% of your income, down on that peak of 57%. In Australia, upwards of 49% of income required to service a mortgage over there. And I think that's a really interesting one, right? Because I thought that once affordability improved here, we'd see increase in demand. And so I thought the same thing of Australia, but it hasn't really impacted them much. And that's really because even though it's costly to get that mortgage, as long as you've got your job and you're comfortable, you're going to keep that and income's going to keep rolling in, you can pass those serviceability tests, people are still going to continue to act in that market. So that affordability metric that I thought would be also crucial to see the value growth occur in the future doesn't really seem to be playing out across Australia, and really makes me put even more weight into the fact that we really need, for any solidifying of our property prices for those owners that are already in the market who want to see property price growth, it's really going to take an improvement of our economy and an improvement of our labour market for really anything to change in that perspective, not just affordability improving to, as I say, the best levels since 2019. So that's really the thing for me to watch. What happens with the economy? Where does the labour market go to? How do we shape up through the rest of this year into next year? And then longer term, just setting that expectation that we do expect growth to be lower than it has been in the past due to all those reasons we've spoken about. So I think that is pretty much me for the day. A plug for our weekly podcast. As Jenny mentioned earlier, Calvin and I catch up every Monday, have a chat about the latest data that was out. Today we previewed the official cash rate decision on Wednesday, which I suppose I should touch on very briefly. Calvin sits he's our economist, he sits at 55% chance of a 50 basis point cut. I sit at a 51% chance of a 25 basis point cut. So, it's pretty tight. It's pretty tight. And I think, it'll be interesting to see what the Reserve Bank call. The key for me is we got this bad GDP figure for Q2 a few weeks ago, and the discussion off the back of that was the economy is weaker than we thought it would be, and so it requires more support, which means more interest rate cuts. I think the interesting thing now is that data is so old. It's Q2. We've now finished Q3. There's been more data come out, not the official GDP figure, but more data come out more recently, which shows our economy has likely increased through Q3, maybe even 0.6%. So, reverses some of that loss that we saw in Q2. The key for me is how much stock the Reserve Bank put on these unofficial but more up-to-date measures of the economy and say, this loosening monetary policy we've been through for the last 18 months or so is actually starting to take effect now, despite that volatility that occurred in Q2. And so they carry on their normal trajectory, which is 25 basis points this week, 25 basis points at the end of November. Or do they go, no, it really was that bad. We've got to provide more support. If in doubt, go higher, harder, earlier. And then you could maybe even not do the 25 in November if you don't need it. So that's the big debate for me, and that's what I'll be looking for in their review on Wednesday. But yeah, pretty 50-50 call on that. I think the bank's typically expecting around about 50. Some of their interest rates changing in the last week or so tells me they've got some confidence in that. But yeah, as I say, we'll wait and see what the Reserve Bank do. And we also put a podcast out following the statement. So on Wednesday afternoon, we'll have a reaction podcast come out. So if you really want to get close to it, then go subscribe, get that auto download, and you'll hear from us on Wednesday afternoon for an even more up-to-date conversation than we've had today. I will take a breath. I will take a drink. I'll end it there, and then we can see if there's any questions that have popped up or anything else that people want to know about.
Thank you, Nick. That was a very informative presentation. I'm just having a look at our members who are online, and we don't have any questions that have come through at the moment. Actually, one has just come through from Mark. Why are floating rate mortgages more popular in Australia than New Zealand?
Yeah, it's a great question, and one I don't have a full answer to, and I've asked this a lot of many people I know, both here and across the ditch. Essentially, it's the way that the banks are funded. I guess a lot larger market over there, and so they don't have to fix their deposits the same that we do in New Zealand. A lot of, if you're getting your money in the bank, or the bank needs that money to loan out, they typically get that via local deposits. They do get money overseas as well, of course, but the banks, even though they're Australian owned, still act independently. So they fund the fund. It's basically as simple as the funding in each country is different, and then they can provide interest rates that cover that accordingly. And then of course they price it similarly as well, price it accordingly to that as well. So it's probably not a comprehensive answer, but it's simply about bank funding. The banks have to raise that money. To do so, they pay out term deposits. They pay for 6, 12, 24 months, whatever it is. And so then they flip on the other side for lending. And so they have to offer interest rates that are similar to that. But yeah, that's really the core to it. Why they are in that position, I guess it's a size thing. But yeah, that's the short answer I can give, really. I'm not a banking funding specialist, unfortunately, but hopefully that does the job.
That's great. Thank you, Nick. We don't appear to have any other questions come through. So thank you to our members for joining us, and thank you so much, Nick, for your time and your presentation. Thanks, everybody.
No, appreciate it. Thanks, team. See you soon.
Thanks. Bye.